Welcome to Synergize, unscripted conversations where we explore the evolving role of the financial advisor in an emerging AI-driven world. Join us as we bring together thought leaders across a range of disciplines and industry experts, sharing insights designed to help RIAs thrive in the industry of tomorrow.
Welcome back to Synergize. I'm Bill Capel, Director of Client Growth at TradePMR, a Robinhood company.
And I'm Ryan Neal, Editorial Manager at TradePMR Robinhood. And Bill, we are in 2026. It is the new year. 2025 was a pretty huge year for yourself, for myself, for TradePMR and Robinhood. But it's behind us now. We're looking ahead. Today, we're talking about what's coming forward, what this new year has in line with us, because I have a feeling it's not going to be any slower than last year was. What do you think?
I agree 100%, Ryan. In fact, I've been around for a while. And, this industry has always been subject to changes, regardless of what's going on in the world. I think what's key here going into 2026 is the acceleration of change, how quickly things are happening. And I think the challenges that face us are interesting because they're different. And while change is a constant within our industry, I think right now we're managing this thing at warp speed.
That's right. So our guest today is here to talk to us all about looking forward. Today's episode is all about what we see coming down the pike and how advisors can prepare for it. So our guest is Pete McGratty. He is the Executive Director of RIA Development at Verdence /RIA Plus. We're going to have him talk a little bit about that, and he's going to share his unique perspective on the industry. He didn't just start as an RIA, long career in institutional finance and investing, and he has a unique perspective to bring to this conversation. So, Pete, welcome to the podcast.
Thanks so much. I really appreciate you guys inviting me. I've been working with TradePMR for over 15 years now, and you guys have been a fantastic group of people to work with, and I'd love to watch your development and your growth and your increasing role in this industry.
We'd love to hear that. Pete, do you want to start maybe just telling our audience a bit about who you are and your firm? And I know we have in our notes here, it's Verdence /RIA Plus. I want to talk a little bit about what that is before we dive into our conversation.
Yeah, so real briefly, Verdence Capital Advisors is an independent wealth management firm located in Hunt Valley, Maryland. We have offices up and down the East Coast, Alexandria, Virginia, Naples, Florida, Sarasota, Florida, up in Boston. So our genesis is really the mid-Atlantic, but frankly, we now have clients in 40 of the 50 states, and we now manage for those clients about $4.6 billion. The firm really operates in four groups. There's the traditional wealth management business that works with high net worth individuals doing planning and investments. We have another group that works with professional athletes and entertainers. We have a third group that works with the ultra high net worth individuals and families. It's a family office business. And the fourth group is Verdence RIA Plus, which is the group that I'm leading here at Verdence. And that's really an acknowledgement that the business model that we created and all the resources that we invested in have proven themselves to work in supporting our own staff advisors and allowing our firm to grow from roughly $1.5 billion 6 years ago to $4.6 billion today. And we saw an opportunity to share what we've learned and share the resources that we've invested in and built and put together with other independent wealth managers around the country.
That's fantastic. That transition is an interesting transition. And I'm sure that a lot of what you experienced prior to joining the RIA space has been helpful. And, with that kind of lens, Pete, let's have a conversation around what you see coming down the pike for the industry in 2026. As I mentioned in the introduction, things are happening pretty quickly. AI is having a major impact. We're looking at issues around succession planning in the face of a huge wealth transfer on the horizon, next-gen advisors, technology, etc. Share with us, from your perspective, how you think things like the client experience is going to really be impacted by what's coming.
When I started in the business 15 years ago, the big trend was the movement of advisors from the FINRA broker-dealer world into the independent channel. where they're regulated by FINRA. And as you know, the driving force behind that was there were some conflicts of interest that you're going to identify that the wealth managers were experiencing on the FINRA world. And they were doing some things that were not always in the best interest of clients. And then, of course, there was bureaucracies and other things that impacted the advisors directly. And eventually they threw up their hands and said, I want to be independent in the independent channel, both because we think it's the fiduciary standard is a better standard for our client. And secondly, because I want the freedom to take care of my clients the way I see fit. So that's really been underway for the last 15 years that I've been involved with the wealth management industry. The second thing that has been going on during that period is I'm a long-standing believer that there's sort of four legs to the stool of an RIA firm. The first is in terms of the value that they provide. So leg number one is really the fiduciary standard. We're going to do things that are in the best interest of the client. We're only going to get paid by the client, and we're going to avoid having any conflicts in servicing that client. The second leg of the stool is we're going to limit the number of clients that we work with so that we can have a proactive relationship and really know who our clients are and provide them the best service possible because we know them. The third leg of the stool is doing robust financial planning, not just as a loss leader, a small, a single plan done up front in order to help win the business, but ultimately a robust plan that is being executed over time, over the life cycle of the client, addressing their needs at any given time in their life. And then the fourth is obviously providing best-in-class investment management. I think the growing concern and the growing realization among a lot of those advisors is now there's a new game in town. That's the consolidators, and they look and feel the same as these traditional firms to the client, but in fact they may have very different goals and very different values when you look at those four legs of the stool. So, for example, in terms of the fiduciary standard, some of these firms are getting very large. They're starting to expand the scope of the products that they offer. And in doing that, sometimes they're now starting to recreate the old wirehouse, except they're doing it in the independent channel, in that they may be selling products in addition to just providing service for fees.
It's almost like the wheels coming full circle.
Exactly.
The industry, wirehouse world, the move to independence, and now the scale bringing us all the way back around to through the looking glass, as it were.
Yes, and that's the point that I'm getting to, and we'll tell you some of the implications of that. If you look at the second leg of the stool, you're starting to see some of these large firms. I don't want to speak. I don't want to characterize everybody as doing this, but there are certainly a number of firms that are doing this, where they're starting to stack. Instead of 100 to 150 clients per advisor, you're starting to see, 300 plus advisors to a client. That shifts you from a realm of I know who my client is, I know them by name, I know their situation, to a reactionary environment where I'm dealing with them when I get a phone call. Very different part of the model from a value standpoint.
So let me jump in with a quick question on that, because that's a very, very interesting point. How does technology play into that? First question is, why do you think they're doing it? And is it scale that's giving that advisor the ability? Because I've heard this before, where as an advisor, with the technologies available, in theory, I could handle more relationships. Talk a little bit about that.
Historically, if you've looked at the brokerage business, if you've looked at the asset management business, if you've looked at the wealth management business, the primary driver of that business has always been the personal relationship with the customer, or the personal value of the broker or the money manager or the wealth manager. I don't think that will ever change. It's that trusted relationship that drives that business. And technology ultimately is a productivity tool to help the advisor be more efficient in servicing that client, but it is never going to trump that relationship. And so I think it becomes, you may have the best technology tools on the planet to serve your clients, but at the end of the day, the human mind only has the capacity to proactively manage a limited number of personal relationships. So once you move beyond that, it becomes a much less robust relationship.
So that's really interesting. Kind of a different spin on this because we hear so much from the technology firms about the increased efficiencies and scale, and for firms that want to grow, that technology and all the efficiencies that it brings will ultimately let them serve more clients. And you seem to be taking maybe a different approach to this. So, but I would love to ask you. Um, so then where do you think the efficiencies from technology allow you to do if you want to keep your client to advisor ratio around that 100 to 150, what efficiencies are new technologies driving, and how are they helping, how are your advisors using that to improve their practice if they're keeping a sort of cap on their client level?
Well, so this is, I'm not going to pretend to be a technology expert, but
That's
based
fair,
on the
that's fair.
conversations I'm having with advisors, I think there's a lot of excitement around AI right now. I would split the AI opportunity into two groups personally, based on my conversations. First is, you know, more simple things that help folks manage their day. It's not much different than us having this Zoom conversation, which we couldn't have a long time ago. That solves remoteness, and now you're starting to have transcription services that can capture all this and immediately put it into your CRM. And now you're starting to have some basic AI that can pull the summary information out of those transcriptions and make notes of that in the CRM. And so all of a sudden, now you can look back in a very efficient way and understand what we covered in the last client conversation, and we also have a to-do list on what we need to do before our next conversation. So those are typically the expediencies that we've seen with a lot of different technology evolutions over time. I think the more fundamental AI solution is still in the making, uh, and it's a much bigger task for the advisor to accomplish. What do I mean by that? Ultimately, for AI to be successful, it means you have to have your data uh, aggregated in a common sandbox and organized and vetted to make sure it's all good data. And only then is AI ever going to be able to fully realize its value. Of course, that has the problem that most wealth management firms tend to have trouble with, and that is investing ahead of revenues. That's going to be a big investment lift. It's going to be a big effort lift, and it's going to be a longer term strategic project that has to take place before you can really start to realize the AI.
Yeah.
And that's something, for example, Verdence, we've been undertaking that for the last 2 years and have finished that project. That took a lot of effort and a lot of expense, and now we're starting to explore how to apply AI to that data set.
I'll let Bill take the next question here, but I just want to share a line that I read recently that was AI won't replace advisors, but AI could end up replacing advisors who don't learn how to use AI.
Yep.
Sort of, you like kind of like figure out this technology, figure out how you could use it in your practice, or be left behind. And my personal favorite use of the technology, easily hands down, is the one you said, transcription. From my
Mhm.
reporter days, when I would record interviews, or I'd be out in the field and I wouldn't have a notepad, so I would just take notes,
Mhm.
audio. Then I would have to sit down and manually transcribe that
Mhm.
myself, and my God, it was the worst. It was the
Yeah.
worst part about the job, hands down. So I had this technology back then, would have saved me hours and hours and hours. But anyway, I'm getting on the sidetrack. Bill, I'll let you take the next question.
Yeah, thanks, Ryan. I wanted to. I thought make a quick comment. I thought your observations, Pete, around this notion of what the human being uh, can absorb in terms of relationships is very important, and I want to underscore that. That is information that's been around for a long time and it's been well researched. And I think that it's an important point to make here, which if the game is get more people, that hits squarely on this whole notion of the client experience. If the client really wants a relationship, hard to do with 350 people, to your point. I want to go a little further on client relationships because I think they're extraordinarily important. You've already raised this as being a fundamental differentiator between firms, for one. And when you think about this in the context of scale, what you're thinking around creating scale while at the same time preserving that personal relationship.
So the way I view scale, and I think it's changing a little bit. Uh, let's look back 15 years ago when I first got into the business. I got into the business to help build an outsourcing solution to support other independent wealth managers. The core of that offering was basically solo practitioners and small ensembles do not have scale, and so they're spending their time, too much time in the busy work associated with running the business as opposed to sitting in front of clients and prospects. So outsourcing was basically a way that they could achieve scale without having to do the busy work of doing the investment and all the effort of executing on that investment themselves in-house. So that's where it was 10 years ago. I think it has actually changed and requires even more scale today. So fast forward to today, that's part one of what outsourcing's value is to a firm. The second piece is now they're competing against larger firms that have a broader offering and and oftentimes have a more sophisticated offering. And so now the outsourcing is not only about freeing up their time, but arming some of these firms with the breadth and depth of offerings that will allow them to be competitive. Because the reality is today, there's lots of surveys that support this, that clients are now talking to, 2 or 3 or 4 advisors before making a decision to choose one. And 15 years ago, let's take an example with 2 advisors. Those 2 advisors looked very similar. They were the same size. They also might have been a solo practitioner or small ensemble. Fast forward to today, you may have that same solo practitioner or small ensemble. They look like a small organization. They may be operating out of a small set of offices. They still do the planning, and they're still offering one strategy, probably a passive strategy with multiple risk models from conservative to aggressive. Then they go to door number 2, and now they meet a larger firm, and that larger firm has large offices, and they're very nice, and the client walks in and feels like, oh, I've made it. It's a sort of an aspirational thing. Scale, not only is scale about creating a more efficient business and freeing up your time to focus on the client, but it's also when you're in front of clients, having the tools in your tool belt to compete and look like you're competitive against some of these larger firms.
That makes sense. As this is a great conversation. What I want to do is shift just a bit, Pete, and as we think about launching into 2026, using what you've already stated as sort of the context and background, what are the 3 things you're really focused on in 2026 to continue to grow your business?
Well, let me speak specifically to the folks that we're trying to help, because this, I think we figured out our model and it's working successfully. Now we want to share our model with other independent firms, and this comes back to where we started the conversation, that there's this division now between the large firms and the small firms, and so we just sort of walked through some of the advantages of scale that a large firm has when they're competing with a smaller firm. The second piece of the second thing that's different between the large firms and the small firms is what their values or their goals are. So increasingly, the large firms are viewed as, because they're PE backed, they're much more professional. They have professional investors that are looking for a return. And so the shift of focus often moves from putting the client first and providing the service to that client first. Some of those resources get shifted to sales and marketing because the firm needs to add clients and add AUM so that they can improve their valuation for the next sale to another PE firm or to go independent or to go public. And we've seen that happen. I won't use names, but we've seen some large firms go public, um, and the advisors became very unhappy because the resources shifted from supporting clients and advisors to sales and marketing, and they just didn't feel the love anymore. I have a long list of examples of that you can go through. By contrast, the smaller firms want to stay focused on the clients and they want to stay focused on providing them good solutions, but they're lacking the scale that they need to be competitive with the larger ones. So I think what's happening, it's become very, very clear over the last year, if you attend the conference cycle, that this realization is starting to come clear, is to the point, Ryan, that you made earlier. We've kind of recreated some of what we left when we moved from the FINRA broker-dealer world to the independent world. Some of that's being recreated, and not for the good. And the difficulty for the more traditional firms that want to stay focused on clients and service is, to the client, very often the value proposition looks similar. So the point is that I think you're seeing the world divide into two. And what's going to happen is the smaller firms who want to stay true to their values are going to have to start figuring out how to work together, either through joining together and building a firm committed to those values and building the scale that way, or finding a way to capture those resources and that scale through outsourcing.
Great. Well, Pete, thank you very much for joining us. I'm going to move to wrap up our conversation, but I'm going to throw one more at you. What's a prediction? Let's brief one here, sort of lightning round. What's a prediction you have for what we're going to see in 2026, and how advisors can prepare for that?
Well, I'd say along the lines of what we were discussing, I think we are already seeing advisors starting to look for new ways to work together to solve this issue. I'm seeing it in succession conversations where advisors want to make sure that their clients and their employees land at firms with similar values rather than taking the big check from the large firms. I think that you're going to, the second thing I think you'll see in 2026 is, I think we're on a 3-year path to much wider adoption of private investments. I think the last year or so has been about recognizing that I need to offer this and starting to get educated on what private investments are and who are the people who I can partner with to be able to offer that. I think 2026 is going to be people starting to shift from education to implementation, and starting to partner, actually start to set up and begin to employ those solutions with whichever partner that they choose. And then I think the following year is going to be those early adopters starting to take share because they've got the differentiated offering, versus those that are still playing catch up. A third one, which is a speculation of mine, but anecdotally is confirmed increasingly. I think that there's still a lot of talk with the large consolidator firms about all the firms that are joining them coming in the front door. But I think there's going to be a growing story over the next couple of years of advisors sneaking out the back door when they realize that this offering wasn't what they thought, or because of the growing pains associated with these firms now finally having to consolidate all the things that they bought. So just to give you a simple layman's example, let's say you've bought 10 large firms, 10 regional firms. You now got to start to consolidate these things and integrate them. That means name changes, that touches the client. That means pricing schedules have to start to be consolidated onto a narrower group of pricing schedules. That touches the client. Why do I have to change? Why is my pricing changing after 20 years? The third one, obviously, is the technology. All these firms use different technologies, and that has to get integrated. And we all know that as good as we get at this, that there's accidents along the way that impact clients. So again, the client is touched on that. And then the advisor who's answering all these questions and trying to keep the client happy as all these changes take place, then finds that the firms now are going to consolidate all the pay schedules for all the advisors across these firms, and now their P&L is impacted.
Well, that's a lot. That's a big prediction for our lightning round end.
That's great,
So,
Pete.
Perfect.
Great. Well, we're gonna wrap up. Pete, thank you so much for joining the program. We appreciate having you on.
I love being here. Love working with you guys. I'd love to continue to work with you and see how we can help TradePMR solve the problems of more of these emerging advisors.
Well, great. Thanks, Pete. And thank you, everyone else who tuned in and listened. Wherever you're getting this podcast, whatever platform, Spotify, Apple, YouTube, wherever, if you can like, you can subscribe, you can share, all those things help us out. And we'll catch you on the next episode.
That's right, Ryan. And make sure you watch for our next episode, as Ryan said, where we'll bring you even more insights and actionable ideas to help you grow your business. And remember, the challenge is yours to capitalize on what the future offers.
If you want to join the conversation or connect with us, please visit us at synergizepodcast.com. This content is provided for general information purposes only. The views expressed by non-affiliated guest speakers are their own and do not necessarily reflect the opinion of TradePMR or its affiliates. TradePMR and its affiliates do not endorse any guest speakers or their companies and therefore give no assurances as to the quality of their products and services. This channel is not monitored by TradePMR. TradePMR does not provide investment advice, tax advice, or legal advice. TradePMR is a member of FINRA and SIPC. TradePMR Inc. is registered with the Securities and Exchange Commission, SEC, and the Municipal Securities Rulemaking Board, MSRB. TradePMR provides brokerage and account services to registered investment advisors. Custodial services provided by First Clearing. First Clearing is a trade name used by Wells Fargo Clearing Services, LLC. Member SIPC, a registered broker-dealer and non-bank affiliate of Wells Fargo & Company.